What are you doing? Welcome to the portfolio. Hope you are doing well. Hope your portfolio is also with the crazy market that we've seen recently. Hope your portfolio is doing well. So in today's video, we are going to cover we're gonna go over the portfolio, look over some few things. There is a lot of activities happening, just changing things around in the portfolio. I'll go over that with you. We are going to go over We're going to go over the S&P 500, just take a look at things, see how things are doing. We are also going to take a look at IBM here. We're going to take a look at the numbers, go over some few things, and we'll just look over the portfolio, share some few things, share some few thoughts on the market, and yeah. So the most important thing that has happened this week is the portfolio finally hits $211 in straight up passive income. I did not have to do anything to get this money. It was literally just money being paid to me by all the companies that I own across different sector and across the portfolio here. $211 is not a lot of money, but it is quite a milestone because this is not a lot of money in this account, but for some people this is a lot of money, and for some people it's not a lot of money. But for your average person in the world, really, it is quite a lot of money. So getting the chance to be able to invest in the market and earning money from all these companies that we all own, that we all buy their product and use their services, is actually something really, really great. I'm so happy we finally hit the $200 mark. So really, really excited. I'm looking forward to getting up to the next $500, $1,000 in dividend income here. Very much looking forward to it. Now if we pop over to the activity sector here and we just filter by just the dividend only, you guys can see how the dividend comes into the portfolio and the companies that are paying the dividend. So here you can see Progressive, Realty Income, Stock Capital, Dollar General. You know, the money just comes in little by little, bit by bit, and you can see here we're now starting to hit the dollar mark for most of this company. Foot Locker, QQQ, what's it called, SPHD here. This is like YouTubers' favorite dividend investing. Probably not the best one though, because it's gone down a lot. Although it's called low volatility, it really isn't. But we earn $13 here, 60 cents here, and you guys just see how the money comes in. It's not really much, but over time this will grow because the money that I get paid gets recycled back and gets deposited back into portfolio. But if we really go quickly here and take a look at some of the numbers for the past one day, this is like last week Friday, the portfolio generated about $1.46 here. In the past week the portfolio generated $3.54, and the past month $35 for the past 30 days. So the portfolio, the income aspect of the portfolio is doing just fine, and over time my goal is to grow this to replace my actual income. If I go for month, if I click on the month view here, my goal is to have enough money invested so that I can get paid every month. That will be more than what I'm making from my income right now. That's the primary goal for the dividend aspect of the portfolio. And yeah, that's pretty much it with the dividend. Let's take a look at some of the activities that has been going on in the portfolio. So as you know, the market has kind of been shaky lately. So what I've been doing is I've been cutting some of the companies that I don't believe in their growth anymore. So I've been cutting some of those out. As you guys know, for me, I'm an investor that I try not to sell any stock unless the fundamental of the company has changed tremendously. So what I did was I sold out of General Electric, Hewlett Packard, Carnival Cruise, and IBM. I'm gonna show basically the same thing. Is the same reason why I got rid of all this four, but I'm gonna use IBM as an example in just 1 minute. And then what I did was most of the proceeds that is gonna come, most of the proceeds that is gonna come from the sale of that, I basically put them into really boring companies, Walgreens, put them into Kimberly-Clark, CVS, Tyson Foods, and then I rotate some of them back into the monthly dividend portfolio, monthly dividend payers. So SCHD, this pays every month. This one also pays a dividend every month. SPHD pays dividend every month. That's the one that I just showed you guys that paid $13. And then the rest is just my regular dollar cost averaging that I'm trying to get put into some of these companies like NEO, Tesla, and yeah, that's pretty much it. And then the rest of the money that was left from the sale got put right into the Ark Invest. As you guys know, I've just recently added Ark Invest to the portfolio, and I'm just trying to slowly dollar cost average into it and build up my stake in Ark Invest. So looking in here now, this is like the first week of actually putting money in Ark Invest. So most of the new money that has been coming into the portfolio has just been going right into Ark Invest. It still has a long way to go. I allocated 20%. I allocated 20% for Ark Invest here. I allocated 20% for Ark Invest. So you see it has a pretty decent ways to go. But so far the market has gone down by, let me see, for the week here the market has gone down by, let's see here, by 4%. Let's see what Ark has done in the past week. So it's gone down by almost 7%, but which is fine by me because I'm just starting this side of the portfolio and just trying to grow this over time. So here basically at least $5,200 is still waiting to go into this sector of the portfolio. So right now we only about $117 in this sector of the portfolio. So this is why I like to dollar cost average into my holdings, because let's say if I had put the entire 5,000 and I put it in and I'm down 6%, I'll be like, whoa, like, like this is not the best thing. You just invest and you're down 7%. So this is why I like to slowly put money into the market and buy at different times, because that's the best thing to do when it comes to long-term dividend, long-term investing in general, to just slowly dollar cost average into the portfolio. So that is pretty much it for just the general coverage of this portfolio. It's doing exactly what I needed to do. Happy to report to you guys that I finally hit $211 here in dividend income. So I'm very, very excited about it. Looking forward to when this would be, couple of $1,000s when I click on a month here. Looking forward to when that will be a couple of $1,000s. And as you guys all know, I have set $1 million challenge for myself to get this portfolio up to $1 million. So lots more changes and improvements to come to the portfolio. And the overarching goal for me is, if I click on all time here, overarching goal is over time I want to grow the percentage that the portfolio grows, and I want to get this to be over $1 million one day. I don't know if it's going to take me 10 years. I don't know if it's going to take me 20 years. I don't know however long it's going to take, but I will be dollar cost averaging into the portfolio and sharing it with you guys. So in case anybody's out there and thinking about anybody out there thinking about investing or trying to get into the market and don't know how to, go and check out the Dividend Investing playlist, which I showed you guys what I've been doing with this portfolio ever since it was $100. I started this portfolio with $100, so, and I started it in this 2020, well, no, 2019 actually. But this data started collecting in May 2020 because I transferred some stocks in from my previous portfolio. But I've documented everything, so go check out the dividend playlist on the playlist section of this YouTube channel. Here are some of the companies that I've cut out of the portfolio because I really don't believe. I've checked out each of them. I've checked out the numbers. I've gone over some few things, and I really don't believe they are gonna add value to my portfolio. So I cut them out. But I'm gonna use IBM now as an example to show you guys the reason why I cut some of these companies out of the portfolio. First of all, sorry about the ads, guys. I haven't really paid for this stuff, so if you see an ad, sorry about it. Bear with me. So taking a look at IBM here, this is how I look at a stock. Either when I'm buying into it or when I'm selling out of it. This is what I do. I take a look at just take a look at the numbers. If it makes sense, I'll hold on to it, research more into the company. If it don't make sense, I literally cut it out of the portfolio, like I just showed you guys just 1 second ago. If you take a look at IBM here, we look at the maximum years that they've been available. I mean, that they've been out in business. Obviously, they've been in business for a long time, and they were very innovative during this time, in the 80s and 90s, right? And then they came down, and they were still innovative during the 2000s, and it looks like the peak for IBM here was 2013, and since 2013 that it was $200. As you can see, the value of the company have just been coming down drastically. This is the company has lost 20% of its value, 22% of its value in the past 10 years, 20% of its value. So within 5 years, it lost 2% of its value, 20% in 5 years, 17% in 1 year, and yet today here they've lost 16%. And you can just keep on going down all the way down to the present day. They basically lost money. They just gained a little bit here, but the overall picture for IBM is basically not looking great. When I just look at the general performance, the general performance of the company, not looking great. If I pop here into the financials really quickly, and we take a look at the numbers. So just like individuals, you have to look at companies just like individuals, right? If you're a regular person, you're an individual, you work, you make $5,000 a month, and you're spending $7,000 a month, that is not a good look. You're not gonna be able to survive or have money to invest or anything like that if you spend more money than you bring in, right? So if you have more expenses than income, it's not a good look for you. It's same thing too with companies. If we take a look here and we look at the gross the total revenue, that's total amount of money that comes into the company. As you can see, since 2015, the company has basically been losing money year over year. Year over year, they've been losing money. 81 million here, 79 million. They've basically been losing, right? If you end up looking at a gross profit as well, it's basically been going down. 40, 38, 36. So this is in millions, by the way. This is in millions. So they've basically been losing money, and even if you look at their there you go, the total income here, they've basically been losing money from 16 million in 2015 to 2020 here to 9 million. So that is not a good look for a company that you want to invest in and you want them to grow. So that is not a good look. If we look at the balance sheet as well, let's take a look at the balance sheet here. Keep in mind that all the numbers are in millions. So taking a look at their balance sheet, let's look at these numbers together really quickly. Total cash, short-term investments. Yeah, it looks like they invested into their business, but their investment is not paying off. Total receivables, even their receivables have been going down too. Like the money the money that they've provided service and they're waiting for the income to come in, so that is also going down. So the numbers are not looking great for IBM. Their total current asset has also been going down. Let's look at the liabilities here. This is the more interesting numbers. So currently their current liability has been going up. Granted, it came down from 32 million here to 37, but their current liabilities are basically creeping up again. And then we look at the long-term liabilities here. Look at the liabilities. That's the money that they owe, debt and all those things, credit cards. In terms of regular folks, this is your credit cards, it's your student loans, it's your mortgage, that kind of a liability. But for a company like IBM, this is their numbers here. You have 96. So basically their liability is just going up. As their income is going down, their liability is going up, right? So let's see. I mean, this shareholder equity part don't really matter. But as you guys can see, let's look at the cash flow for a second. So okay, so let's look at the cash flow here. Cash from operations. You see the income has basically been going down. And remember, this company has like their long-term liability is huge, right? And their income is also going down. So I'm not comfortable holding IBM at this point, so that's why I'm deciding to sell out of it. If you look at the dividend here, the payout ratio, the total amount of money out of their income that they pay to investors is 77%. They pay $6.52 every year. But like I said, there's no point in having investment in a company that gives you a very high yield, which is 5.8%. This is pretty high. But there's no point in owning a company that's technically the actual stock price itself, it's going down. If you look at 10 years here, like I showed you guys earlier, look at 10 years, the actual stock price is going, the actual enterprise value, the stock price is going down. So it don't really matter how much money the company is paying you. If the total enterprise value is going down and the future income is going down and the debt, so the income is going down, the debt is going up, and then they're paying investors 77% of their income just to keep their record here. So I don't really like the numbers that I see here. Let me show you guys an opposite company. Guys, something similar. I was gonna actually pull up Apple, but then again, I can't really compare Apple to IBM. So I'm showing you guys Intel. This is Intel, just the same. They're basically in similar. It's like a similar company. So if you look at the maximum time here, we look at the total growth. So they've gone up. They've had their ups and downs as well, but they've shown like steady growth. For 10 years, within 10 years, your money would have gained 120% growth. You can see 30% in 5 years. This year you lost money. So far this year you're down basically this year. But if you look at 5 years, you're up 30%. If you look at 10 years, you're up 120%. This is the kind of numbers that I like to see. We pop over and look at some of their financials. Give me a second. Pop over and look at some of the look at their financial gross revenue. See, year over year, it's just been going up. It's just been going up. This is what I like to see in any company that I invest in. Gross profit just been going up year over year. And I haven't looked at this before I opened this. I'm literally just looking at it right now. Operating income, as you can see, boom, boom, boom. It's going up year over year. This is the kind of things that I like to see in a company that I'm invested in. Same thing too, if you take a look at the dividend here, they've grown their dividend 6 years straight. The past 5 years, they've grown it by basically 7% here. The past 7%. The payout ratio. This is the thing that scared me about IBM. They paid 77% of their income out. You see, to investors. That's not good. That is not good. If you want a company to survive, you can't be paying all your money out to investors. Even though I'm a dividend investor, I love receiving those income. But the bigger thing is I want to make sure that the companies that I'm invested in, that I have ownership of, I want to make sure they can survive. So annually they pay out $1.30, and the dividend yield is 2%, almost 3%, which is good. It used 3%, and potentially every year you can get an increase of 6% of this yield. That is good. That's something that is manageable. So the financial is good, the dividend looks good. We are going to take a look at the income part of their balance sheet. Let me take a look at the balance sheet here. And companies like this is what I like to see. The cash and short-term investments, basically it's the numbers are going up. This is what we like to see. Total revenue, numbers are going up here every year over year. This is what we like to see. Current asset, their current asset, it went down a little bit here in 17, 18 it went down, but it's starting to go up, which is a good thing. You want the company that you invest in to own productive assets, so their assets is growing up year over year, so that's a good thing. Let's take a look at their life. Perfect. Look at that. If you talk about like long-term liabilities, they actually, it's gone up recently. It's gone up this year. But in general, their numbers look a lot better than IBM, so that's why I decided to get rid of IBM. The general point of what I'm talking about is I've taken a look at all these companies. The IBM was just one of the examples that I want to show you guys. But I've taken a look at all these companies, and they basically all look the same. Their debt, their liabilities, their debt is going up, the asset is going down, and the stock price is going down with it. So I decided to take my money out of this and basically put them into other safer, productive assets that will be adding value to my portfolio year over year. And as a steward, this is how I look at my portfolio. My primary job with this portfolio is to grow it over time, and I cannot own any company that is basically losing money, you know. Taking a look at the S&P 500 here, let's see, year to date we're not doing too bad as well. We're not doing too bad, even though this year has been a crazy year, the most bipolar year I've ever experienced in the market. But we are not doing too bad. We're up just not even 1%, 0.5% here. But from the low in March, we are up 46%. That's the most important part of this information I'm trying to tell you guys. The tiny downfall that we've experienced here, which is like almost 7%, is nothing compared to the growth that the market have seen for the 46% growth that the market have seen in the past, let's say 6 months or so. So technically the market hasn't really dropped that much. As you guys know, like I'm just slowly trickling back into the market. I'm not buying a lot. I'm not putting a lot of money into the market. I'm putting roughly $250 or so per week into the market. Back in this time when the market was dropping so hard here, I literally was putting like $250 per day. So what I'm doing right now is I'm just putting a little bit of money into the market, waiting to see what is going to happen with the election, what's going to happen with the stimulus check, and all this drama that we all are dealing with, the coronavirus. They're locking down the UK again. Europe might be looking like it's going to get locked down. So we could see another pullback to where the S&P was $222. So if we get a pullback to that time, I want to have enough ammunition, which is cash, to be able to go back in and start buying good companies with great deals in the market again. That's what I'm waiting for. I don't know if it will ever get to this point again, because the most likely the Federal Reserve, the central bank, will not let the market get this low again. But we'll see. This year has been a very, very surprising year, so anything can happen. But right now, all I'm doing is just slowly buying back into the market, because we've seen this pullback here. I really didn't buy anything. I was just waiting and seeing, waiting to see what happened. And we had this uptrend. So this second pullback here, I'm looking to just slowly trickle back into the market. But if we ever see S&P at $220 at some point from now to the end of February, I'll be buying aggressively again, and hoping that overall that helps push my portfolio to the next level. Because as you guys can see, the last time we saw stocks drop that low was in 2018, that we saw stock drop this low. So if we see stock go all the way back down to that point again, I'm gonna be buying into the market aggressively at that point. But for now, I'm just putting a little bit of money into the market, $250 per week, and yeah, we'll see how the market does over time. Those of you that are interested in looking at the portfolio, if you want to take a look at my portfolio, click in the link below and look at this. Click on this link. You can click on this link. It will show you how my portfolio has performed and all the stock that is in the portfolio. You can actually check it out by clicking on this link. This is updated every single time I post a video. And for those that are interested in joining M1 and doing investing, doing something like I'm doing, you can click on this link. This is the this is the referral link. By using this referral, you'll be supporting my channel. I appreciate you, and let's get back into the video. I refuse to own companies that are basically losing money and losing investors' money. So that is pretty much it for this week's update. I hope you've enjoyed the video. If you like what I do here, please take a moment to give the video a like, subscribe to the channel if you like what I'm doing, so you can watch my journey, watch what is like for an everyday regular person, individual investor, growing their portfolio, growing their income. As you see here, I've grown this income to $211, and I'm looking forward to it growing over time as well. So thank you for watching. Until next week, love you all. Bye.